Good morning, everyone. We're going to start into Chapter 8 today. So Chapter 8 is on capital gains and capital losses. So we've referred to this now several times, and now we're going to finally get to this topic and dive a little deeper. So you guys should have some familiarity with this from what we've talked about here and maybe from your other accounting classes as well. So Chapter 8 does a little more of a deep dive into this topic and this set of rules. So capital gains and capital losses are once again one of our sources of income that we're going to add into the pot here to calculate our net income for tax and our taxable income. Another piece of the puzzle, but we're going to dive into those rules that are specific to that type of income. And we learned in Chapter 5 that this could, in Chapter 5, we learned that this could derive from the disposal of, a depreciable asset. That was just one way that this could happen, right? If you sold, say you had an asset that you were using in your business and you sold it for more than you bought it for. Now that's a less common scenario. Usually you've used up, that stuff is depreciating, so you're usually selling it for less than what you bought it for. Now, we don't have a capital loss for depreciable assets, only the gain. So we learned a little bit about that in Chapter 5. So you could have these gains from depreciable property. You can also have capital gains and losses related to that same property we talked about in Chapter 7. But the capital gains and losses follow their own rules, kind of special rules, regardless of where they're derived from. So let's jump into the slideshow here and talk a little more about capital gains and losses. So a couple of things just to note here, a little bit of history. The taxation of capital gains began in 1972. And then in 1985, we have something else that came in called a lifetime capital gains deduction. We'll talk a little bit about that one. This only relates, however, to qualifying small business shares. Generally speaking, there are a few other items as well. But this is, for now, let's say this is very specific. This isn't an across-the-board thing. So we'll just put that on the shelf for now. Oh, oops. I can mention here, sorry, it says here, small business, farming, and fishing assets. That's what this specifically shares, not just any old asset in a business. So that's a very specific thing as far as qualifying for this exemption to the tax. But otherwise, in 1972, that's when the taxation of capital gains began. And since 72, we've had what we call different inclusion rates. What the inclusion rate simply means is that as of now, since 2000, only 1/2 of that gain is taxed. So if you have a capital gain of $100,000, you can multiply that by 1/2, and you are only going to pay tax on 50,000. So this is the gain, right? You might see this on your financial statements. But the taxable portion is only 1/2 of it. This is why it's so important to make sure that you are correctly classifying when your income is coming from a capital gain, because this is a big win, right? This is what we would call preferential treatment. You would like the income to all be called capital gains so that only half of it's included as a taxable item. This rate has changed over the years. It started at 1/2. Certain point it was 2/3, 3/4, back down to 2/3. Right now we're at 1/2, and we've been there for more than 20 years. There have been, over the last number of years, some rumblings of increasing this rate back up, but that has not happened as yet. But that's just another example of taxation rules that can change and then can have a ripple effect through the kind of tax advisory world. So as of now, it's only 1/2, and our job is to make sure that we are properly classifying things as capital gains, because there's a lot of money in the difference here. So let's define what a capital gain is. So it is, or results from, the disposition of a capital asset. So it isn't simply the change in value. You have a building, a property, you got the building and the land, and the value went up 50,000 this year. You don't have to pay tax on that. But if you dispose of that asset, then perhaps you will have to pay tax on the capital gain. Now, Canadian securities are also considered capital property. So the important thing here is going to be the definition of a disposition and the definition of a capital asset. Because in order to have the gain, you have to have both. You have to have an asset and you have to dispose of it. And we have talked about this a little bit as we went through chapter 5 and 6 already. But Canadian securities, right, shares, stocks, that sort of thing, would also be included in this category. And we're going to talk about more items that would as well. So let's start with defining that word disposition. So the most common way, or what everybody's going to think of, is when you sell. So you have an asset, you sell it for more than what it was worth. That's how you're going to create a capital gain. But as we've mentioned in previous classes, there are other ways to create this disposal. It sounds negative. It sounds like you're throwing out the trash, right? I'm disposing of this. But it just means that you no longer own it. So we can, no longer own. So this could be in a positive or a negative way. Number one is a sale. And again, it's not always a gain. Sometimes it's a loss. Sometimes you're selling it for less. So it's not always wins, right? Especially if you were trading in shares. Sometimes you're going to win, sometimes you're going to lose. So there can be different terms along the way here. You could be, redeeming some sort of a right or something. It could be something that's expiring based on a timeline or a date, cancellation of a right, conversion, maybe of something from one form to another. You could be transferring it to another legal entity, like a trust. This is, and it's not always even just trusts, right? Like maybe it's, to a family member. I don't think that's on the list here unless it's, no. One of the, big things that people will forget, they'll think, well, I've got some shares in a company, but I want to just gift those to, say, my child or something. I'm just going to transfer that into their name or something like that. Now, there are options to do this with a spouse. That's a little different. But when you transfer stuff, say, down to the next generation while you're living, that disposal, that's a disposal, right? When it transfers ownership from one person to another. And whenever you have a disposal, you potentially have a capital gain. So although the big picture here is that with the capital gains, this is positive. You're only paying tax on half of it. And in theory, you've made money. But we also have to be very careful in our tax planning that people don't unintentionally trigger a disposition. Maybe the disposition's unintentional, but the capital gain not intentional. There's my scribbly version of the word unintentional. So sometimes that can happen, particularly when you're transferring ownership to, say, a trust or family member or something like that. That is a disposition, and you would have to pay tax if there was a capital gain. There's lots of other, so that would be, maybe that transfer to a family member would be considered a gift, right? You wanted to gift it to your child. So that could be under that category as well. Or the gift could be to anybody. That triggers a disposition, which means that affects your taxes. You're the one who owns it. You're the one who is disposing of it. So this can happen even when there's no money changing hands, right? So that's the other thing to keep in mind. You don't have to actually be receiving a whole, boatload of money to create the gain. You could have just given the asset to somebody. You've got a piece of land. You bought it for $25,000 40 years ago. Now it's worth, $500,000. And you go, I'm just going to gift this to whomever it is, your friend, the family member. Well, the bad news for you is you have now triggered the capital gain on that asset. As the land appreciated in value every year, that had no impact on your taxes. But now that you've disposed of it, the disposition is that is the trigger. It's the disposition that triggers the taxable gain or loss. Yeah, well, that was a really messy version of the word gain, but you get the gist. This one you'll see a little, not very often, but expropriations. The government comes in and says, hey, we need this land. We're going to build a border wall between us and the U.S., keep the Americans out, but we're going to need your land in order to build this wall. They take your land, and they reimburse you, hopefully for that, at some sort of market value, and there you go. That's created a disposition. So obviously that would not be a preferable situation. By the way, also I should mention too here in the gift situation, we're talking about market value. So since there's been no money change hands, we are going to deem it to be disposed at market value. And I believe the next slide here is going to talk about proceeds. So we'll get into that topic. And the last one on this list, there are various deemed disposals, which means you actually haven't disposed of it, so to speak, but we will deem that you have disposed of it because of things like a change in use. Has the asset gone from personal to business? And I don't mean, when you talk about a vehicle or something, that's a shared use, that's fine. But we mean a total change in the use. The death of a taxpayer is also a deemed disposition. So when you pass away at the end of all of this, all your assets are deemed to have been disposed. So this is where the kind of have a day of reckoning, so to speak, and all the taxes need to get paid for any of that, maybe growth or anything else that may have occurred over the lifespan. So, and this can, you might hear of somebody saying, so and so, they passed away and they left their family a tax bill or something to deal with. Well, that's not true. You do not inherit somebody else's tax owing, like a family member or something. That's not how taxes work. Everybody has their own individual tax bill. However, if you wish to receive, there's a couple of scenarios. One is you are the recipient of those assets through the will. Well, before you can receive, the regular tax bill has to be paid, right? Any gains that relate to any dispositions, things of this nature, that you have to have those final taxes settled out. You're also in Canada not paying tax on the inheritance. So there's no tax on the inheritance. If the taxpayer had outstanding taxes owing, or if new taxes are owing due to the triggering of these dispositions or whatever, of course that stuff would have to be dealt with. But to me, that's not really they left you with a tax bill. It's just that the taxes have to be squared away before the difference can be inherited. What's available in the difference. So that's a very different thing in my mind. Just to be clear, you do not pay someone else's tax bill. That's not your responsibility. Now, somebody's going to have to be the executor and deal with the actual taxes and make sure the payment happens and everything else. But it's a little, you know what I mean? There's a nuance there to what that really means. So just to back up here, so the definition of a capital gain is we have to have a disposition of a capital asset. So this was our definition of how a disposition can occur. So there's lots of different options outside of your standard sale. And it can also be just, like that word, disposal, got rid of it. That can, it's not worth anything to us, so we gave it away as a gift or threw it away or whatever. We talked about other examples. It could be destroyed in a fire. Vehicle can be, and now a vehicle, you're not going to have capital losses. It would be possible to have a capital gain if the vehicle was, maybe say you've got like some sort of a collector item, fancy old race car or something that actually appreciates in value. So that's possible as well. There's lots of, tons of different scenarios that you could have. So we have to define the proceeds of disposition. We need to give that a dollar value. So how much did you sell it for? That could be it. Insurance proceeds. How much did they pay you? If the government took, say it's land or whatever, if the government took it for you, what did they pay you for the expropriation? And then other various deemed proceeds. Now remember, deemed, when we're talking about tax and we're talking about the word deemed, that means, we have kind of what you call the real world over here. There's the real world. But then we have over here tax world. Wow, what a fun place that sounds like, tax world. So we got the real world, we got the tax world. We know what's going on in the real world over here, but because of our rules, we are going to deem that things are happening under the rules of tax world. So in other words, you didn't get any proceeds. Your real world proceeds were zero, but we're going to deem that in tax world, your proceeds were X. So let's say usually what we're talking about here is market value. So you didn't actually get a penny. Maybe pennies don't exist. We should say a dime. Over here, market value is the number that's going to go on that tax return and create the capital gain. So fair market value is what we're talking about. So that would be used in the case of a gift, right? So you didn't receive anything, but you still disposed of the asset, or change in use of the asset. So that's one part of the calculation, right? We need to know what are our proceeds. Then we have to know what our cost was. So we call that ACB, adjusted cost base. For depreciable assets, right, for all our stuff from Chapter 5, we just use the capital cost. For non-depreciable assets, we use a cost with some adjustments. And this comes from the Income Tax Act, ITA 53. So, what adjustments do we make? So, of course, the cost is, we start with what you originally paid. Sometimes when you bought that asset, it was funded in part by government grants. So, the same as how you would treat this for accounting purposes, right? You have the, purchase price minus whatever you got from the grant, and then that's what your asset that's going to be on your financial statements is. you subtract its net of the grant. That would be our normal GAAP procedures. So you do the same for this. We adjust the cost to take out the grant before we move forward. Now, all of this stuff matters again because when we're calculating this gain, only half of it's going to be taxable. So the fact that we're taking out the grant is going to adjust what the cost base of this calculation, right? So it's very important that all the pieces are in there because it's going to change how much is taxable. So you wouldn't want to miss taking this out because it'll change the ultimately where you end up, right? All right, so let's keep going. Superficial losses, that's to do with shares. We'll talk about that when we get more into shares here. So let's let's go ahead and yeah, it's in the slide here now. So let's go ahead and do it now. So superficial losses, we'll use the example here as the easiest way to show it. So superficial losses, first off, are not going to be allowed because remember, we're talking here about capital gains and losses. You don't always win. Sometimes you have a loss. A taxpayer may have incentive to create a loss. So the taxpayer may have incentive to dispose of the asset, to recognize the loss, but then immediately repurchase the asset. So this is what we would refer to in certain circumstances as a superficial loss. So it's a sale combined with a reacquisition 30 days before or 30 days after. So in other words, if all of this happens in a very small window of 30 days, then we're going to call that a superficial loss and we're going to disallow it. So in this example, now securities is the best example for this because we're talking about an identical item, right? It's an identical security. If you buy a share of Google and you sell it and then you buy it again, you have bought the identical property, just potentially at a different price. So in this example here, we have securities with a cost base of 15, and then we sell them for 10. So, you know, if this cost us 5 more than we bought it for, than what we sold it for, we would think of that normally as a loss of 5,000. 10 minus 15, 5,000. But this loss would be disallowed under IT 40 if the identical securities are purchased again within that 30-day window. It would be deemed that you have only done this in order to trigger that loss to help your taxes because you now have those shares again. What happens to that disallowed loss? The disallowed loss correct. This is only when it's within 30 days that you've, I'm going to call it repurchased identical securities, the exact same ones. So what happens is that triggers that 5,000 loss to be disallowed. And then that 5,000 is added to the 8,000 of the new purchase so that you have a new cost base of 13,000. So the story happened here. One day you buy some shares for 15. Later in the future, you sell them for 10. Normally, that would be a $5,000 capital loss. However, if within the 30 days you go ahead and just buy them back again, then that's considered a superficial loss, and it would be disallowed for purposes of the tax, and instead added back in to create the new ACB. So these slides are all defining adjusted cost base. So for depreciable, capital cost. For non-depreciable, it's cost and then adjustments could be made. So all these other adjustments, if there's a government grant, you deduct that from the cost or the UCC. If there's a superficial loss, that's an adjustment, as we added the 5 to the 8 of the repurchase to get 13. We can sometimes have an adjustment for stock option benefits. Sometimes this is added as an employment benefit. That was mentioned in Chapter 3. And sometimes that's added to the cost base of the shares. Another note on adjusted cost base, kind of similar to when we were looking in Chapter 5 and you've got UCC and the UCC goes to negative. If any adjustments make your cost base negative, you can't have a negative cost base. So you have to get that cost base back to nil. And if so, that would be added to income as a capital gain. We're going to talk about if you go on to tax 2, there's a whole chapter on partnerships. And so we'll talk about your cost base of your interest in the partnership. And that's where this can kick in. So you don't have to worry too much about that here, but that's something that will feed into Chapter 2, where that cost base can't be zero, or can't be negative. You have to at least bring it to zero, and anything further to that becomes income. Let's see. All right. So here's how you would lay out a simple calculation of a taxable capital gain. And I will remind you, be very careful when you're looking at questions. Read them very carefully. Is it referring to a capital gain or a taxable capital gain? If the question tells you the capital gain, you know that you have to chop it in half to get the taxable amount. If you're told the taxable capital gain, right, if you're given that right in the question, then you don't have to do anything else. You just have to add it into income. Because this is all going into the same basket and being run through the tax rates and the applicable tax credits and whatnot, and deductions being applied. The taxable amount is what will actually run through your tax brackets. So in order to calculate this, pretty straightforward. You take your proceeds, you subtract your adjusted cost base, and then lastly, you also subtract any costs of disposition, anything that you had to pay in order to get that disposition done, right? So this could be, maybe commissions, legal, maybe even ourselves here, accountants, some accounting. Anything that it costs for you to be able to complete this disposition. That comes out here. Now, why is that important? Well, we would be motivated, right, as the taxpayer, we would be motivated to take these costs and let's say, our motivation would be just to deduct those 100% on our income statement, right? That would be a bigger deduction. By including them in here, we're effectively only getting 50% of the deduction. So we would be motivated to go ahead and just stick that into your regular legal fees or your regular accounting fees. But upon inspection and audit, an auditor could say, no, you know what, those don't belong here. So therefore, half of it is getting disallowed and your tax bill's going back up. So because of this 1/2 inclusion rate, there can, as the numbers get bigger, this can have a big impact on a tax bill to properly classify the proceeds, the cost, and properly classify a transaction as one that would create a capital gain. In order to, in case it ever did come under inspection or audit, examination, and then ended up being reclassified. So this is your general manner of how you would always calculate this. There's an example here as well for identical properties. So when we're talking about an identical property, we're talking about like shares, right? Again, you buy a share of, in this example here, of X Limited. One share is exactly the same as another. They're the identical, it's one common share or whatever it is of X Limited. So if it's the exactly identical property, this is how you would go about making that calculation. Now, we know with shares, you can have a number of purchases, right? You can have many purchases. So when we're looking at the cost base for shares, we're going to look at this right here. Best way to put it is basically we're going to use average cost. So in other words, if we look at this example, we have an individual purchasing 100 shares of X Limited at $12 per share, right? So I don't think there's, no. So if we have, we bought 100 at 12 each, then we bought 150 at 14. All right, so we'll do this first here. So, right, so that's like $1,200. And then we had 150 at 14. So that'd be like 2,100. And we also bought 75 at 11. So that'd be 825. Right? So various different purchases at various dates. This is building up an average cost. So in other words, here we have, what do we got? 100. So what we have, 325 shares. And this cost, check the math here. What do we got? 1,200 plus 2,100 plus 825. Yeah, that checks out. So that's $4,125. So we simply take the 4,125 and divide it by the 325. Now, those were all purchased at different points in time, but they were all in inventory. So you're basically keeping an inventory of your shares, of the securities, and keeping an average cost, an average price that you've paid. So right up until the moment of the sale, this was our average price, or our average cost, I should say. Then the next thing that happened was 100 shares were sold for 20 each. So 100 times 20 is $2,000. The cost base, average cost, is $12.69, and we sold 100. So it's 1,269, creating a capital gain of 731, one half of which would be taxable. So remember, that's the capital gain, and then the taxable would be one half. So simply put, whenever at the time of any sale, you take the current average cost, multiply it by how many you sold, and that's going to be your adjusted cost base. And subtract that from the proceeds to get the capital gain. Divide the capital gain by 2 to get the taxable portion. Now you could have a series of these, of course, right? So you bought a couple, sold some, bought a couple more, sold some. So you're constantly keeping that average cost calculated for your inventory of the shares so that you know what that average cost is just before each sale. Because right after this, it could say, well, then we bought a few more, then we sold some more. So you could have a series like that of this kind of basic average cost calculation. Also keeping in mind the timing of the sale, just in case there's any superficial loss. Now, sometimes when you're disposing of a capital asset, it may be what we would call a partial disposition. Now, this can often happen based on land, or in the case of the disposition of land. So, maybe you've got a large piece of land, but you're only selling a portion of it. So you have to come up with a reasonable basis for valuing that land. So if it's very simple, you can just prorate that based on, the acres. Although we can get into a gray area here, unless there's other factors. Is there a portion of the land that borders a lake or something, and therefore, and it's in a residential area, and so that portion of the land is worth more. That sort of a thing. So a lot of, times we'll end up in tax with this word reasonable. And, that can, that's where gray area comes in. Who determines what reasonable is? What would a reasonable taxpayer do or decide on, right? So that's a wide open area there, but this partial dispositions, we have to try to figure out a reasonable way to do it. And sometimes there would be some guide, that's where you could maybe look for some guidance to see what CRA considers reasonable. Let's see. I want to skip ahead here. I'm not going to get into any detailed calculations here with principal residence exemption. There is a formula and all of this, but suffice to say, for you guys can look through this. There isn't a question on this on the assignment, but generally speaking, your principal residence is not a part of all of what we're talking about here, right? So if you have a home, that's where you regularly reside. When you sell that home to move into a new one, there may be some reporting on the tax return nowadays. Didn't used to be, but there's a principal residence exemption there. So you're not going to pay tax every time you move to a new house. That's not what this is all about. But it can affect other properties. If you've got rental properties or vacation properties, that sort of thing. So I want to talk here about personal use property. And there is a question on your assignment for this one. So personal use property is property that is used primarily for the enjoyment of the taxpayer. So this could include something like a cottage, and gains on those types of property are taxed. However, losses, so gains are taxed, but the losses are not deductible. So the government gets to kind of have their cake and eat it too here. If you sell that vacation property or that cottage or whatever at a loss, you don't get to deduct it. But if you sell it at a gain, that gain should be reported and taxes paid. 1/2 of the gain would be taxable. And I think really a lot of people are kind of unaware of this and may underreport in this category. On the technical side here, the proceeds for such a transaction are going to be a minimum of 1,000, and the cost base is also going to be a minimum of 1,000. What this means, this doesn't mean if it's under 1,000, you don't do anything with it. What this means is if either of these numbers are under 1,000, they are, there's that word again, deemed to be 1,000. So in other words, if the proceeds of disposition are 800 and the adjusted cost base is 400, you would think I've got a gain of 400, but you don't, because we are going to deem those to each be 1,000. And therefore, you've got 0 instead of $400 gain. So that's what this minimum item, this little technicality here means. So we're not going to deal with any numbers under 1,000. Every number is going to be bumped up to at least 1,000. So this includes more than, this personal use property would include more than just, like a cottage or whatever. This could include, maybe you have a boat. It could include other vehicles like cars. Again, most cars, so your car that you use every day would be considered personal use property for your enjoyment, making it easier to get around. Whenever you sell it, you're, always selling these, generally speaking, for less than you bought them for. But you can't claim that as a loss. When you go sell your car, go trade it in, you cannot claim that as a loss on your taxes. So this falls under that gains taxed, losses not deductible area. However, if you did have some sort of a vintage collector automobile or something, it's possible that you could sell that for more than you originally purchased it for. Technically, those gains would be taxable. So any kind of personal enjoyment property here that you're able to sell for more than you bought it for is going to fit under here. So your primary residence would be under this category, but it's exempt. So it would only be additional properties like a cottage or a rental property. Remember, in chapter 7, we were talking about the income that you derive from a property. So maybe you had shares that paid you dividends, or maybe you had a rental property that paid you rents. Now we're talking about those shares and about that rental property if you dispose of it altogether. So chapter 7 is like we held the asset and we're earning a stream of income from it. In chapter 8, we're saying we got rid of it. We sold it, we disposed of it one way or the other, and created a gain. That's the difference between chapter 7 and chapter 8, but it's all deriving from the same types of assets. So in chapter 8 here, there's a section that goes into detail. We won't have time today, but there's a section there that goes into detail on your primary residence. But generally speaking, that primary residence is exempt from all of this. Now, it can get convoluted if you're moving around a lot and have multiple properties, and that's why there's some extra explanation in the text. But we're not going to get into that. But for most folks, you live in one house, you move to another house, that's where your family lives, that one's exempt. It's going to be a straightforward thing, even if you have other rental properties, because you designate which one is your principal house. And it's that if that designation gets complicated and changes around a bunch, then that's where. But for most people, you're living in one house, and you when you decide to move, you don't have to pay any tax on that. Now, we also have another category, though. So this one here is your personal use property. There is another category that's a little more specialized, and this one's called listed personal property. So those are two different things. This is like a little specialty category that only specific items will fit into. So this is called listed personal property versus personal use property. So the only things that fall under listed personal property are this kind of specific little list. So this is going to be a little more rare to see on a tax return. we'll see personal use property and shares and things like that. Like most often capital gains, you're going to see it's for, say, a rental property or shares. That sort of thing is what you're going to see on so personal use, as well as your identical properties, the stuff we did with shares. That's the kind of stuff you're going to see. Sale of land, that sort of thing. That's what you're going to see more commonly as a capital gain. But we do have this other listed personal property, a little more like collectors here. So works of art, jewelry, rare books, stamps, coins. I don't know anybody has coin collection or stamp collection anymore, but this stuff, these kind of rare items that can appreciate in value, these ones, they give you a little more leeway because they're like a specific kind of a collection or whatever. In this case, you can use the losses, but only against other listed personal property gains. So they have to stay in their lane and stay in the same category here. So the gains will be taxed, the losses can be claimed, but only against other LPPs. And that $1,000 rule is also in effect for this category as well. Let's see. We're not going to worry about the foreign currency stuff here. So deemed dispositions, get some more detail. Again, this I mentioned about death of an individual. There's some more detail on that in Chapter 9. The taxes for a person when they pass away. There's a whole other a lot of stuff that happens there, right, in that final tax return. We're not going to go into deep detail with that, but just know that there's special stuff that happens there, and a lot of it is related to these deemed dispositions and capital gains that can be created, and there is some more of that in Chapter 9. But changes in use, departures from Canada. So this is kind of like day of reckoning stuff here, right? If you're leaving Canada, we talked back in Chapter 1 about changes in residency. If you're no longer a resident of Canada, well, then we need to square up. We need to square up on that growth that's happened in the value of your assets. So when you depart, you need to pay the taxes on it's the same as a regular disposal because you're gone from Canada. We need to have these rules in here so that people can't just build up a big amount of wealth and then just leave so that they can not pay the taxes. So you lived here for 40 years, but you're going to leave and then dispose of the assets the next day so that you don't have to pay tax, right? So it's to close off loopholes, right? So that in that case, when you depart, you're going to have to come clean, so to speak, and pay the taxes then. Again, you don't have to pay tax as these assets grow. Year by year by year, the value goes up. You don't pay taxes then. It's only on disposal. So therefore, we've got to kick in some rules to close loopholes here, and that's where that deemed disposition. So again, deemed just means you're going from real world to tax world. We're saying, we know in the real world you still have this asset, but because you departed Canada, changed your residency status, now we're going to just act as if. That's, I guess, best way to. We're going to act as if, and that's usually going to be based off fair market value is what we're looking at. So we're going to act as if you sold it. So these deeming provisions you'll find throughout the Tax Act for different scenarios. So change in use, we're talking more like from personal to business, or your principal residence is no longer a principal residence, or your rental property becomes a principal residence. Different changes can affect things. Changing your residency. So this, again, the departures from Canada doesn't mean, oh, well, you took a 2-month trip. We're talking about Chapter 1 stuff. We're talking about residency. And death of an individual, this is day of reckoning stuff here. Again, all of those built up gains have to be settled out. And there's more detail in Chapter 9 on that. Let's see. So the example that they have here under change in use, here somebody has a sailboat. So this would be, we'll assume in this case that this sailboat was something that was able to be used in the business somehow. Maybe they were doing tours, let's say. So this was a business asset purchased in order to do tours. Purchased at a cost of $200,000. It's been depreciated because it was a business asset. So we have a UCC at 125. And we know the fair market value has risen. And so it's actually worth $250. So boats are an example of something that can appreciate in value, a little different, than you might think of it as a vehicle to get from point A to point B, but it's not quite like our cars that are always worth less the minute you hop into it. So if this sailboat, it was decided, maybe this touring company said, well, we're going to buy another sailboat. We want a bigger one or something. And then the owner says, well, I'm going to just take the old sailboat and I'm going to make that a personal asset now. So that would mean that the business is disposing of it. The use has changed. So we're going to have 250 minus, so the market value minus the cost. That's going to be a gain of 50, a taxable gain of 25, the 1/2. This will also create a recapture, right? That's our old Chapter 5 stuff. That kicks in too because it was a depreciable asset. So the recapture is the difference here, right, of our cost and our UCC. Because we had written off $75,000. So we have to bring that back. Basically, all the depreciation we had claimed, well, this thing didn't even actually depreciate. That's what recapture means, right? You've been depreciating an asset, but hey, turns out it didn't depreciate at all. It actually appreciated in value. So the part that's the gain is the market value over the cost. The part that's the recapture is the difference between the cost and the UCC. In other words, I'll call this difference is if there's a gain, if it's that far off, it's the, let's call it historical CCA in this type of a scenario where you're actually having a gain. Why is it important to break these up? The gain is only 1/2 taxable. The recapture is 100% taxable. Big difference. Now, I don't mean a 100% tax rate. I mean that whole amount will be multiplied by the tax rate. taxable gain, only half, or sorry, for a capital gain, only half of it, the taxable portion, will then be multiplied by our tax rates. So one of the things that can confuse people around tax is that rates and things will be quoted as like an effective rate. So effectively, the tax rate on capital gains is X, but from a technical standpoint, all of your income is just all thrown in one basket after all the rules are followed. Every one of these chapters in the text is telling us rules about different income sources. Then it all goes into the pot and gets multiplied by the same tax rates based on that progressive system. So the next dollar, depending on your income, could have a different rate. So there's no specific rate for a source of income. It depends on how much income you have. What tax bracket are you at? What's your marginal tax rate? But effectively, it will be, well, in the case of Chapter 8 in capital gains, it'll be 1/2 of whatever that rate is. For dividends, it will be a certain percentage because you could factor in the dividend tax credit that you're going to receive. That will kind of build and create what your effective tax rate is. But it's still, from the mechanics of it is, it all goes into a pot and gets multiplied by the same tax rates. So that kind of, if you think about it that way, it kind of simplifies it a little bit. But often things will be quoted as an effective rate. And that's just not how it's done. Again, taxes are calculated and tax forms are done very deliberately, step by step by step. So something as simple as changing the use here for the business can create this capital gain and recapture. So that one was 200 UCC. What's this next one here? So going in the opposite direction, you have a personal sailboat. So you've got this sailboat that would be under that personal use property category. You bought it for 200, but it has a fair market value of 250. When you transfer that to business use, you have created a capital gain of the difference, the 50. Now, there's no UCC because you don't depreciate personal assets like that, personal use property. But the business would now have a UCC. So the UCC for the business would be the cost plus the other half of the gain that you didn't pay tax on. So you got a capital gain of 50, taxable of 25. The other 25 you didn't pay tax on gets added in for a new UCC of 225. And the capital cost being the fair market value. So it's a question there about recapture. So recapture, again, we learned recapture in, recapture, this is a Chapter 5 topic. So you can, that stuff sneaks back in here again, right? So you can refresh yourself on that in Chapter 5. But again, recapture, so it's the exact same thing we were talking about then. But conceptually, we're saying that if our UCC, undepreciated capital cost, is 125 and our cost is 200, that means that over time we have claimed CCA of 75,000. That's the only way we could get there, right? So year by year by year, we're calculating CCA and claiming it. So we started at 200 when we bought it, and every year we claimed some more CCA, and we've gotten all the way down to 125. Then we sell the asset, but we sold it for even more than we bought it for in the first place. Even if we had only sold it for 200, we would still be selling it for the same as what we bought it for. So that means it didn't actually depreciate, right, in the real world. So we have to square that up. We have to reconcile for that. So we have to basically take back that 75,000 that we claimed as a deduction over time, and we have to add it back into our income. So a recapture is an addition to our income, and it's created when you basically sell an asset for more than the UCC. I guess that so sell for greater than UCC is what would create a recapture. I think it's the simplest way to say it. Oh, another good question. Assignment 2 grades. I will apologize for being slow on the assignment 2 grades, but you guys are going to get those in the next 24 hours. Oh geez, we are at 9:46. So I think that gives you guys a pretty good start. There's a few more things here. Don't worry too much about this other stuff here. The main stuff you have on your assignment there is around the personal use property, the listed personal property. There's a sample question on Brightspace under, let's see here, under content in class. There are sample questions. Let's see. Yeah. Solution to assignment problem 8. That includes a sample question 8.8, which covers personal use property. And so you can have a look at that one. Let's see, was there? If you need anything else, let me know. But that's it. There's a question there on the shares and questions there on the personal use, listed personal property stuff there. So that's the kind of topic matter, anyways, in the assignment that relates to Chapter 8. And again, the assignment, we had extended the due date there, so it is due on the 24th. So that is Wednesday. If you guys have any questions today or tomorrow, let me know. And Wednesday's class, we're going to be doing a special class there. We're going to have a couple of guest speakers talking about bankruptcy and how that works with tax. So that's outside of the textbook, but there will be a question from that on the exam. So make sure that you do attend that class as well. And other than that, if there's any other questions or anything you need, let me know. And have a great day, folks.